Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing WildBrain stock so we can determine if it's a buy or a sell. WildBrain is a media, animation studio, production, and brand licensing company. It is known for owning the largest library of children's television programming, and that library is distributed through its multi-channel network, WildBrain Spark, and a group of Canadian specialty television channels. The company is headquartered in Halifax, Nova Scotia, Canada, and was founded in 2006. Let's get started with the model. This is a small cap company, 359 million market cap. They're trading at $2 a share, and they have 176 million shares outstanding. We're going to look at the ticker that trades on the TSX. So all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They don't generate a ton of revenue each year, but they still manage to have positive free cash flow. It was close to 100 million in 2021, 62 million in the trailing 12 months. Net income is a profit or loss on the income statement. It's revenue minus expenses. They had a big negative in 2020, lots of write-offs, but positive after that. Revenue is a sales for the company, and that grows a little bit each year from 426 million to over $500 million Canadian dollars. Let's look at the capital structure. 76 million of equity, 678 million of debt. They're 10% equity, 90% debt. So they're really leveraged. That's not a good sign. Their net debt is 594 million, and they have a really high WACC, 18%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that 600 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $532 million. We divide that by 176 million shares. And we get a calculated stock price of $3. They're trading at $2, so they're trading at a 32% discount. It's a buy according to the model. Simply Wall Street's value is 162. They're saying it's 26% overvalued. Surprisingly, 6 analysts priced this stock, and the average price target is 351. They're saying it's 72% undervalued. This is where the stock has been trading since 2006. It started out a little over $3. But pretty much for the first 5 years, it was below $3, below $1 for a good portion of that. Then in 2013, 2014, the stock blew up, hitting $10. Then over the next 5 years, it came back down to under $1. It did break through $4 at the end of 2021, but it has regressed since then. There are 40 companies in the same industry as WildBrain, and they rank 28th in market cap of the 40 companies. They do not pay a dividend. They did a few years ago, but they don't anymore. Their price to book is about average, a lot worse than the median, but their PE, price to free cash flow, and price to sales are better than average. They have a great PE, 11.3, and a really good price to free cash flow of 5.8. So it looks like it's a great value. They just have so much debt. To summarize, I have them trading at a 32% discount. I rank their free cash flow as 5 out of 10, their revenue 7 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.